Bring on board Rohit Agarwal, a Senior Executive Vice President and Equity Fund Manager, Kotak Mahindra Life Insurance. Rohit, good afternoon. Thank you so much for joining in with us as always. And let's talk about the run-up that we're seeing in the Nifty. There's no stopping that. What's your view? What's your thought? Is this just an pre-election run-up, pre-election optimism that we're seeing?
Hi. Well, difficult to say if it is a pre-election run-up, but what we could say is it is bouncing back from what happened in March, where there was some kind of a scare related to funding and how the mid and small cap was behaving. You could put it as a pre-election run-up, but at the same time, there is no change in the micro environment, which is earnings. And I think as long as earnings are intact, these run-ups will keep coming every year, in our opinion.
Okay, so the run-ups will keep on coming and the bull market is pretty much intact. But what are those pockets of strength where you can add positions? Because, a lot of pockets are looking a bit toppish. It's got very expensive. Where is that space that you're still finding some sort of value and comfort on the table?
Well, historically, India has always been a market where you will find pockets where you can invest. Some of the pockets we believe are still good are the BFSI space and the manufacturing space. I think they go hand in hand, where in India we are trying to make a lot of Make in India. A lot of it will be financed by most of the Indian banking BFSI space. At the same time, you also mentioned that the capital markets are booming. We can see in the indices that's happening. I think the fee-based businesses, even on the BFSI side, and not just the pure banks, would also be beneficiary. The likes of exchanges, the likes of clearing members, the likes of AMCs, all of that will also eventually be big beneficiaries of what's happening currently in the country.
Right, Rohit, also let's talk about IT, right? What's your thought on the IT pack? Do you think that now it's time that one should start looking at it? We're expecting, improvement there in terms of fundamentally in the next couple of quarters. So is it the right time to start entering at least the big cap, big IT names?
Well, our positioning in IT is slight underweight. The reasons are that even though we expect some recovery to happen in FY25, we do not expect the large cap Indian IT to deliver more than 6-7% kind of growth next year. In that backdrop, most of the valuations at 22 to 25 times 1 year forward are pretty much factoring in that kind of demand coming back. The joker in the pack, if any, could be that if you believe that the interest rate cuts in the US is going to be very, very sharp. Currently, our assumptions are that the interest rate cuts will be more gradual and the recovery will also be more gradual, simply because currently the US has not gone into a recession versus what people had thought that would be a huge recession. And the US labor force and all of those data points have been holding up well. In that backdrop, we do not believe that Indian sector of IT whole as a pack can grow at 12% next year. So if we put that and put the valuations, I do not believe there is a great upside. But yes, if they decline here from 10% or 15%, of course, it will make a case for this sector to be neutral or overweight then.
Okay, so for now, not the most lucrative sector in terms of the risk reward right now, because even a double-digit earnings growth is quite difficult for those companies this year. But what's your view on metals? Because usually the institutional investors try and shy away from that sector because of the cyclicality. But this time, do you see it to be a lot more structural?
Well, metals, in my opinion, is never structural. It is always cyclical. If you actually look at what's happening in the metals across the world, it is a big, big dichotomy. It is not just the industrial metals, but also the precious metals like gold and silver, which is going up. And currently, we are talking about interest rate cuts and inflation coming down. So it's a big dichotomy. Something has to go away. It does not generally happen that equity markets are at a high, interest rates are about to get cut, and the industrial metals and the precious metals are at a high. So in our opinion, even if you look at the metals rally, which is currently happening in aluminium, copper, or all of those, or even steel for that matter, if you look at the spreads are not increasing, but the stocks are going up because obviously there's a trend going on, which is that the dollar will depreciate. And of course, that happens, metals to do well. But there is nothing structural in this, in our opinion. This lasts longer, of course, yes, because that's the nature of the commodity. That's the nature of the sector, where they will tend to stretch on both the sides. on the longer side as well, and also on the downside. But it can never be assumed to be a sector which should be a structural bet. These are sectors where you need to be counter-cyclical. So if from this point on, aluminum rallies and another 10% or so, copper rallies, and other industrial metals rally, and of course, if that happens, stocks will rally. It'll be a good time to then take the money off the table.
And want your view on the FMCG basket? That's been an underperformance. Nothing exciting happening there. Is it that, or do you find that valuations are something that is a bit of a concern still, or is there something that you could look at in the FMCG basket?
Well, FMCG is, as a space, as you rightly said, has underperformed the market simply because the operating performance has not lived up to the market's expectations. Even going into this quarter, when we look at some of the companies that we track, they are talking about not more than 2, 3, 4% kind of a volume growth. So obviously, within consumption, FMCG is a pack which has got suffered because of interest rate hikes and all that's happened because what's going on in the economy. So there, I think there may still be some time. Having said that, obviously there'll be a couple of names which still look attractive. Valuations there also have corrected. And at the same time, we believe that after a quarter or two, if we see some semblance of stability in the operating performance of FMCG, and if the monsoon is also good, you might see some kind of money getting rotated back into this sector because they have not performed up to expectations.
Yes, and the expectation is of the normal monsoon. At least that is what SkyMet is saying, 102% probability of a normal monsoon. So that's something that probably the street is liking as well. On that note, Rohit, we let you go. Appreciate you making time and speaking with us. But time now to